Ladies and gentlemen, let me ask you something important. What would you do if, overnight, access to real money suddenly disappeared? What if the systems you trusted froze, the shelves went empty, and the rules changed without warning? Today's headline is not just news, it is a wake-up call. Bank run, TD Bank suspends silver sales burning alive as silver hits $114. No metal left. This is not speculation. This is a signal, and history tells us that signals like this never arrive quietly. Reports that TD Bank has suspended silver sales have sent a powerful signal through global financial circles, and the reaction has been immediate. When a major financial institution pauses access to physical, precious metals, markets don't just notice, they lean forward. Investors, analysts, and everyday savers are now asking the same question. Why would a bank step back from selling one of history's most trusted stores of value? According to industry chatter and dealer feedback, this move appears tied to unprecedented demand and tightening physical supply, creating a ripple effect that is reshaping sentiment almost overnight. This isn't just another market fluctuation. This is what stress looks like in real time. As silver prices surge and inventories thin, buyers are racing to secure tangible assets, driven by growing concerns over inflation, currency stability, and the resilience of traditional banking systems. When access to physical silver becomes restricted, it amplifies urgency. Scarcity creates momentum. Momentum creates fear of missing out, and fear of missing out accelerates buying pressure. That cycle is now clearly visible across retail platforms, bullion dealers, and institutional channels. Here's the hook that matters. Banks don't limit asset sales during calm periods. They do it when supply chains tighten, risk models shift, or internal exposure reaches uncomfortable levels. Whether driven by logistics, inventory constraints, or risk management protocols, suspending silver sales sends a message louder than any press release. It tells the market that physical availability is no longer guaranteed on demand. For many investors, that realization changes behavior instantly. What makes this moment even more striking is how quickly it unfolded. Only months ago, silver was viewed by many as a quiet hedge, steady, reliable, almost overlooked. Today, it sits at the center of an accelerating rush toward hard assets. Social media activity has exploded. Dealer waitlists are growing, and premiums on physical silver are widening. Every delay reinforces perception. Every shortage fuels demand, and every institutional pause pushes more buyers toward alternative sources. Behind the scenes, market participants point to a broader shift underway. Rising interest rates, persistent inflation, and mounting debt levels have pushed investors to rethink where safety truly lives. Paper promises feel fragile in uncertain environments. Physical assets feel real. That psychological pivot is powerful, and it's unfolding fast. The suspension of silver sales by a major bank, even temporarily, becomes a catalyst, turning quiet concern into active movement. For those watching closely, this development represents more than a single policy change. It reflects mounting pressure across the financial ecosystem and highlights how quickly confidence can migrate when people sense instability. When access tightens, awareness sharpens. When awareness sharpens, action follows. And right now, action is moving decisively toward tangible value. Silver's rapid climb to the $114 level has captured global attention, sending shockwaves through financial markets and igniting intense debate among investors. Moves of this magnitude don't happen in isolation. They reflect a collision of fear, momentum, and shifting confidence. One moment silver was a steady hedge, quietly sitting in portfolios, and the next it became a headline asset, pulling in buyers from every corner of the market. The question on everyone's mind is simple but powerful. What changed so fast? The answer lies in rising investor anxiety and a growing rush toward hard assets. Persistent inflation, mounting government debt, and uncertainty around interest rate policy have created an environment where traditional investments feel increasingly fragile. In moments like these, capital doesn't sit still. It searches for shelter. Silver, long viewed as both an industrial metal and a monetary safeguard, suddenly looks like a lifeboat. As demand surged, prices responded with force, pushing higher in what many analysts describe as a panic-driven acceleration rather than a gradual rally. Here's the hook. Markets move on psychology just as much as fundamentals. Once silver began breaking key price levels, momentum traders piled in, retail investors followed, and institutions adjusted exposure. Every upward tick reinforced urgency. Every new high triggered another wave of buying. Social platforms lit up with speculation. Dealer inventories tightened. Premiums expanded. What started as a defensive move quickly turned into a full-scale stampede for exposure, fueled by the fear of being left behind. At the same time, concerns over the stability of fiat currencies have added fuel to the fire. With purchasing power eroding and savings yields lagging behind inflation, investors are questioning the real value of cash. That doubt has translated directly into action. Physical metals are being viewed not just as investments, but as protection. Protection against volatility, against policy shifts, and against systemic risk. When confidence in paper assets weakens, tangible value becomes magnetic. Market observers also point to a structural imbalance between paper silver contracts and available physical supply. As prices climbed, more investors demanded delivery rather than settlement, exposing strain in the system. That pressure amplified volatility and pushed prices higher still. This is how rapid price discovery happens. Scarcity meets emotion, and emotion meets urgency. What makes this surge especially significant is its timing. It arrives amid growing whispers of bank stress, tightening liquidity, and weakening global growth. Silver's rise is acting as a real-time barometer of investor sentiment, reflecting a broader move away from comfort and toward caution. When an asset long associated with stability suddenly becomes a breakout performer, it tells a deeper story, one about shifting priorities, rising uncertainty, in a market searching desperately for something solid to hold on to. Reports of critically low physical silver inventories are now dominating conversations across bullion desks, retail platforms, and institutional trading floors, and the implications are hard to ignore. When dealers begin using phrases like limited availability and extended delivery times, it's more than routine supply management. It's a warning signal. Investors who once assumed they could access physical silver on demand are discovering that shelves don't refill as quickly as order books. The result is a growing realization that real metal is far scarcer than many previously believed. Here's the hook that's grabbing attention. There's plenty of silver on paper, but far less in hand. Futures contracts, ETFs, and digital representations of silver continue to trade in massive volumes. Yet the amount of immediately deliverable physical metal tells a very different story. As more buyers request actual bars and coins instead of paper, pressure builds throughout the supply chain. Refiners, mints, and distributors are struggling to keep pace with a surge in orders that has arrived faster and stronger than anticipated. Bullion dealers are reporting shrinking inventories and rising premiums, a classic sign of physical market stress. Waitlists are forming, allocations are being capped, some suppliers are limiting quantities per customer. Each restriction reinforces a sense of urgency, and urgency fuels demand even further. It's a feedback loop driven by scarcity psychology. When people sense something is becoming harder to obtain, they move quickly to secure it. This inventory crunch is being amplified by multiple forces converging at once. Industrial demand for silver remains strong, particularly in renewable energy, electronics, and manufacturing. At the same time, investment demand is accelerating as concerns over inflation, currency debasement, and financial stability push more capital toward tangible assets and logistical bottlenecks and refining capacity limits. And the result is a system under visible strain. What makes this moment especially compelling is how suddenly the imbalance has surfaced. For years, physical silver operated quietly in the background of global markets. Now it's front and center, exposing how thin inventories can become when confidence shifts. Market veterans note that physical metals don't disappear overnight, they get absorbed steadily. Then all at once, awareness catches up. That's exactly what's happening now. The growing gap between available supply and rising demand is forcing investors to rethink assumptions about accessibility and timing. Silver is no longer being treated as an optional allocation, it's being viewed as a strategic asset, a form of insurance in an uncertain financial environment. Each empty shelf and delayed shipment adds weight to that perception. When tangible assets start behaving like rare commodities rather than everyday products, markets take notice. Behind every shortage is a message, and this one is loud. Physical silver is moving into stronger hands, faster than systems were designed to handle. As inventories tighten, behavior changes. Buyers become proactive, institutions become cautious, and the market enters a phase where availability itself becomes part of the price discovery process, reshaping expectations in real time. Growing fears of a wider bank run are now acting as a powerful catalyst behind the accelerating move away from paper assets and toward tangible stores of value. It starts quietly, almost invisibly. A few nervous withdrawals, a spike in online searches, a sudden surge in precious metal orders, then momentum builds. People begin asking harder questions about liquidity, counterparty risk, and how much of their money truly exists outside. Digital ledgers. When confidence wavers, capital doesn't wait for confirmation, it moves. Here's the hook that's reshaping behavior. Bank runs don't begin with chaos, they begin with doubt. As headlines circulate about tightening credit, stressed balance sheets, and institutions quietly adjusting policies, depositors and investors alike are reassessing exposure. The idea that funds could be frozen, delayed, or restricted, even temporarily, is enough to trigger action. History shows that once trust is questioned, even strong systems feel fragile. That psychological shift is now rippling across markets. This growing unease is pushing individuals and institutions to seek assets that sit outside traditional banking frameworks. Physical silver, along with other hard assets, offers something paper instruments cannot. Direct ownership without intermediaries in uncertain environments. That distinction matters. Savings accounts depend on institutional stability, bonds depend on policy, equities depend on earnings and sentiment, physical assets depend only on possession. That simplicity is proving increasingly attractive. Retail investors are not alone in this pivot. Institutional players are also recalibrating risk, diversifying reserves, and reducing reliance on purely financial claims. The movement reflects a broader recognition that liquidity on screens doesn't always translate to liquidity in reality. As rumors circulate and market volatility rises, more participants are choosing certainty over convenience, opting for assets they can see, hold, and control. Social dynamics are amplifying the shift. News spreads instantly. Videos of long lines or delayed withdrawals travel fast. Each story reinforces awareness, and awareness accelerates behavior. This is how modern bank-run psychology unfolds. Digitally first, physically second, the speed at which information now travels means reactions are faster, sharper, and more coordinated than ever before. At the same time, persistent inflation and declining purchasing power are adding pressure. Depositors are watching cash lose value while yields struggle to keep up. That erosion creates urgency. People don't just want safety, they want preservation. Silver and other tangible assets are increasingly viewed as shields against both systemic risk and monetary dilution, making them natural destinations during periods of financial anxiety. What's emerging is a quiet but decisive migration of capital. Funds are flowing away from abstract promises and toward physical certainty. Each restriction, each unsettling headline, each policy shift strengthens that current. When confidence in institutions weakens, ownership becomes a priority. And right now, ownership of real assets is being treated not as speculation, but as protection. Driven by a growing sense that financial stability can no longer be taken for granted, market analysts are increasingly describing the current silver surge in tightening physical supply as a potential turning point for the broader financial landscape, one that exposes long-standing vulnerabilities in traditional systems built on leverage and confidence. When seasoned professionals start using language like structural stress and liquidity imbalance, investors pay attention. These aren't emotional reactions, they're assessments grounded in data, flows, and historical patterns. And right now, those patterns are flashing caution. Here's the hook that's resonating across trading desks. Markets don't break where everyone is watching. They crack where pressure has been building quietly for years. Rising debt levels, aggressive monetary expansion, and an ever-growing dependence on paper instruments have created an environment where perceived stability masks underlying fragility. Silver's rapid rise, paired with shortages of physical supply, is being interpreted by many as an early signal that confidence in fiat-based systems is starting to erode. Analysts point to the widening gap between paper claims and deliverable assets as a critical stress point. Futures markets and exchange-traded products continue to trade enormous volumes, yet the availability of physical metal tells a different story. That disconnect raises serious questions about price discovery and systemic resilience. When more participants demand physical delivery instead of financial settlement, there is also growing concern about counterparty risk. In times of uncertainty, investors begin scrutinizing who actually holds their assets, how quickly they can access them, and what protections truly exist if volatility escalates. This renewed focus on ownership and transparency is driving behavior across asset classes. Silver is simply one of the clearest examples of a broader shift toward tangible value and away from abstract promises. What makes this moment particularly compelling is how multiple pressures are converging at once. Inflation remains stubborn, global growth is uneven, geopolitical tensions persist. Central banks are navigating narrow policy paths. Each factor alone would be manageable. Together, they form a complex backdrop that leaves markets highly sensitive to shocks. Analysts warn that when confidence weakens in such environments, reactions tend to be nonlinear, slow at first, then suddenly rapid. Institutional strategists are now advising clients to rethink diversification, emphasizing real assets, reduced leverage, and greater liquidity buffers. This reflects a growing recognition that traditional portfolios may be more exposed than previously assumed. Silver's behavior is being treated less as an isolated commodity rally and more as a symptom of deeper recalibration underway. The message from professionals is clear. This is not just about price action, it's about trust. Trust in currencies, trust in counterparties, trust in systems designed for stability but tested by uncertainty. As silver draws attention to these fault lines, analysts see a market beginning to reassess what safety really means, prompting a shift that could reshape investment strategies far beyond precious metals. Financial experts are now urging investors to slow down, zoom out, and make deliberate decisions as volatility reshapes markets. In periods like this, emotion moves faster than logic, and that's exactly when costly mistakes happen. The message coming from analysts and wealth strategists is consistent. Stay informed, stay diversified, and focus on long-term resilience rather than short-term headlines. When prices spike and availability tightens, the instinct is to react. Professionals, however, emphasize preparation over panic. Here's the hook that matters most. Uncertainty doesn't destroy wealth. Unmanaged uncertainty does. Experienced advisors are reminding clients that no single asset provides complete protection. Silver may be capturing attention, but smart portfolios are built across multiple layers, including cash equivalents, equities, real assets, and alternative investments. Diversification isn't just a strategy, it's a buffer against surprises. By spreading exposure, investors reduce dependence on any one outcome and gain flexibility when conditions shift. Education is being highlighted as a critical advantage. Experts encourage investors to understand what they own, how it's stored, and who controls access, in a world dominated by digital accounts and financial intermediaries. Clarity around custody and liquidity has become essential. Many are reassessing counterparty risk, asking whether their assets are truly theirs or simply claims on someone else's balance sheet. That awareness is driving a renewed interest in transparency and direct ownership. Risk management is also taking center stage. Professionals recommend maintaining adequate liquidity, avoiding excessive leverage, and stress testing portfolios against scenarios such as prolonged inflation, market drawdowns, or tightening credit. These practices aren't about predicting disaster, they're about building durability. Investors who plan for volatility are better positioned to navigate it. Those who assume stability can be caught off guard. Another theme gaining momentum is discipline. Chasing rallies and reacting to fear often leads to poor timing. Advisors stress the importance of setting clear goals and defining risk tolerance, and sticking to a structured investment approach. Markets reward patience more often than impulse. In fast-moving environments, doing less can sometimes be the most strategic move. What's emerging is a broader mindset shift. Instead of focusing solely on returns, investors are prioritizing preservation, adaptability, and control. They're asking smarter questions about asset allocation, storage, and accessibility. They're recognizing that financial security isn't built in moments of calm, but in moments of challenge. As uncertainty continues to ripple through global markets, experts see this period as an opportunity for individuals to strengthen their financial foundations. Knowledge becomes leverage. Preparation becomes protection. And thoughtful diversification becomes a pathway to resilience, empowering investors to move forward with confidence even as conditions remain unpredictable. Merchistan